This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to the chart deck. Listeners, you'll find the download link in the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Juliet's picture saying, looking for the downloads. All right, Eric, let's cover crude oil.
EIA inventory was delayed this week by the American holiday, so I don't have it. The market has drifted back up to the level where it's failed several times previously. So we need a clean breakout above $74 on WTI to signal a new bull trend, and so far, no luck with that.
So, Eric, I put on a tighter 50-day moving average on the chart on page 2, and I highlighted that first quarter of the year trade range, which I continue to think is really important. It's sort of in the 74 to 82 kind of area. And more or less, we had obviously crude oil strengthening off of its lows, but still in a pronounced downtrend. And it's very premature to be talking bullish in any way. But one of the things I will be watching is whether crude oil manages to re-enter that green box trade range zone, because to me, that would get it above its 50-day moving average for the first time since April. And it would be the first time that the bulls would actually have a chance to reverse what's been over a year-long downtrend. Will that happen this time around is certainly what's on my mind. Eric, though, what are your thoughts here on equities?
No change in my view from last week. We're still holding this breakout level well above the 61.8% Fibonacci retracement at 4309. That doesn't make any sense to me fundamentally, but the chart's telling me that this market wants to rally back toward new all-time highs, so I'm on the sidelines.
All right. Well, let's actually get into the levels here with you, Nick. So we have the S&P 500 levels on page 3. What are you watching?
Spot price right now on SPX is 44.50. You have a call wall above at 4,500 and a put wall below at 4,200. The implied move for the July 21st OPEX is plus or minus 80 points. So the upper expected move is 45.30 and the lower expected move is 43.70. Key resistance right now is right above at 4,500. Key support is at 4,400, 43.50, then 4,300. I'm inclined to think we see some downward price action perhaps over the next couple of months, but keep in mind that the first 3 weeks of July, are the strongest weeks of the year, historically speaking. So it's possibly chop around, but I do expect us to pull back down to that 43.50 area over the next month or so. And
Nick, it's interesting that you say that. Like the S&P 500 for me has been in such a strong bull trend, and we had attempted to break out last week to a fresh year high, but so far it's rejected there, and clearly we're weakening this morning on these futures. For me, it's certainly going to be very interesting to see whether or not the bulls can buy this dip, because as far as I'm concerned, if the S&P 500 here can stay above 44.20, 44.40 in this area where we're almost trading into right now, this is a typical area where short-term intraday swing traders would buy the dip and push it right back to the highs. And if we have any weakness that breaks us down to, let's say, 4,400 or lower, then it might usher in the first potential pause in the market advance that could look a little bit like December of last year or February, where we mean revert back down to the 50 or 200-day moving averages. Right now, it's such a critical moment. We haven't no real signal. Right now, I almost assume that the bulls will remain in control, but we're coming to a pretty important point where we're going to find out whether or not they buy that dip. So nonetheless, though, let's move on to the NASDAQ, where that relative strength has been all year. What are your thoughts here, and what levels are you watching?
spot price on Qs right now is 370. There's a call wall above at 375 and a put wall below at 350. The implied move for the July 21st OPEX is plus minus 10 points. So the upper expected move is 380 and the lower expected move is 360, with key resistance right now above at 372, which is the high from March of 2022, and then resistance at 383. Key support is below at 350. Again, I'm inclined to think that we see some selling in tech and some rotation to the small caps. I'm actually pretty bullish on the small caps going into the end of the year. And I think that the large caps have run pretty heavily. We're seeing Apple, Meta, Amazon, Microsoft, they're all peaking right now. And I don't think they have much upside, especially as we go into the Q2 earnings reports, which will be out in the next month or so. So I'm inclined to think that bearish to neutral on big tech, and I'm more bullish on small caps. IWM, which is the Russell Index, is what I'm looking at right now.
What I wanted to talk about is just how we continue to see such low levels of volatility, considering the velocity of even the rally to the upside and the potential for week by week volatility to even emerge. It really looks like volatility is anticipating far more of a narrow range for the rest of the month. What are your thoughts here on the VIX, and what levels are you watching?
Looking at the VIX right now, we're at the spot of around 15. So this denotes about 1% moves in the S&P each day, roughly. So looking at this right now, we've hit multi-year lows recently. And as we move up to the upside, the way I think of it is that there's no forced action occurring right now because typically calls are sold against broader portfolios. And so no forced action is taking place. If we get some surprise event, let's say, for example, that the Fed raises by 50 basis points at the next meeting, which would be a big shock to the market, that's where you can see the VIX take off and see a lot of interest in buying insurance in the form of puts on the SPX. So right now, as we sit and watch and wait for the Fed's action over the next 4 weeks or so, I'm inclined to kind of sit on my hands and wait to see what happens. But there's not much to really do right now because, buying premium might be smart over the course of 2-3 months, but selling it short term is not really a great idea overall. Moving on to page 7, we have the US dollar index. What are your thoughts here?
No real change since last week. We're right in the middle of a wide consolidation zone, and only a daily close below 100 or over 105 is going to change that.
Eric, for me, it's that trade range is prevailing. I think we're going to need a big macro event to really drive a meaningful dollar trend. We've seen, obviously, Asian currencies very weak against the US dollar, but at the same time, you have currencies like the Canadian dollar and the British pound that actually continue to do very well. And so it's just one huge muddle, and there isn't one big intermarket catalyst to really drive a meaningful trend here. And so I, at this point, continue to be of the position that the dollar will bounce around this trade range between 101, 105 until that macro catalyst emerges. At some point, with such low vol in the currency markets, there is potential setup to make some good money when this sets up to break out. But I'm not so sure it's imminent. And so I'm going to be patient and waiting to see where the next major move is. If we see the dollar here reject this 103 area where we're trading, it's not out of line for us to see some short-term dollar weakness back to 101, where maybe the euro heads back to 110, 111 on the upside. But I think I don't see a big US dollar breakdown coming here, at least not yet.
On page 8, we have the gold futures chart, which has shown some weakness recently. What are you thinking here, Eric?
Well, we tested round number support at 1900 and got a nice, healthy $40 bounce off of that level. So now it's time to find out whether that was the beginning of a recovery or just a dead cat bounce. I'm leaning toward the latter and lower numbers still to come, and I'm still targeting around 1860, another $50 below where the market is now.
I can't dispute, Eric, that the sequence of lower highs, lower lows, and distribution is dominant. But this exact level where we're trading on gold is of some technical significance to me. I put the descending trend line on the chart to show just how this kind of consolidation wedge is developing. While there is zero technical evidence of some sort of a breakout or a potential trend shift, and the path of least resistance is totally in line with your view, I'll be watching just if something creates a surprise that drives gold to, let's say, break out above 1950, because that could very quickly change the technical flows and the sentiment if we had that breakout. But right now, the downtrend and distribution is the path of least resistance. Nonetheless, I wanted to wrap up things by looking at the 10-year Treasury yields. And we had a substantial breakout above 4% here, particularly after the ADP numbers. And we're slowly approaching the highs from February, March, which were around that 410 area. It'll be really interesting to see whether or not yields go for a full retest of previous highs. It's certainly the weakness in bonds is dominating on the short term, but will it break to a bearish new breakdown in bonds as yields break out to a fresh multi-year high? I'm not so confident about that, but certainly retesting the highs of the yields seems like the path of least resistance. Finally, I wanted to touch on page 10, the 2s10s yield curve on Treasury. Just we obviously back in March had that big spike due to the regional bank crisis, and how quickly we got into this deep inversion back again under 1%, a negative 1% in terms of the deep inversion. We're approached to those March lows again. It'll be really interesting to see whether this trend continues or whether this is where the bottoms are going to form.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.